Hi, welcome to the debt market update. I'll be speaking about events in the domestic debt market for the month of October. The month continued to witness a schism in the yield curve. The short end of the yield curve, the AAA yield curves moved up by close to 50 basis points, whereas the long end of the curve remained almost flattish. We're actually witnessing a flat credit curve. This is for the first time it happened after 2018. A triple A is at 7.5, the 1-year rate, the 10-year rate is also close to 7.5. So we're actually witnessing a flat triple A yield curve. The govies, the government of India bond yield curve is also relatively flat. The 1-year is close to 6.90. It moved up by close to 20 basis points during the last month, whereas the 10-year continues to be around 740. A 50 basis difference between the 1-year and the 10-year. A relatively flat yield curve. Why this happened? Predominantly, the shorter end of the curve witnessed a constrained liquidity and hence it affected the yields. Banking credit continues to be very robust. So we are witnessing a pickup in the credit growth, which is being financed predominantly also through the certificate of borrowing, through the certificate of deposit, and hence a rise in the short end of the AAA short end rates in the AAA curve. Something interesting also happened in the last 1 month when the minutes of the MPC were put out in the public domain. There appears to be a hint of wait and pause among two external MPC committee members, where they opine that it may be prudent to wait for the policy to see the effects of the monetary policy action taken on the growth, and it would be the RBI should, the MPC should adopt a policy of wait and watch, whereas 4 other members continue to go for a larger rate hike. On the US front, across the yield curve, it's a flat yield curve from the 3-month at close to 4% to the 10-year at 4%. A 3-month at 4% to a 10-year at 4% is a classical sign of probabilistic recession setting in the US. It has been a very useful marker in the US, but only time will tell whether this marker continues its efficacy or not. On the portfolio side, we continue to believe the fact that interest rates have largely peaked out, and we are posturing a portfolio based on that view. Our preference is for government security through AAA credits because the spreads are very narrow. For investors, the carry in the portfolios across the yield curve is now hitting 7% plus, and we believe it's a very attractive point for entry. For if you are on the short end of the curve and if you have lesser risk appetite, stay on the short end of the curve, that is in the money market kind of funds. Whereas if you have a risk appetite which can take in volatility, please move into the longer end like short-term funds or dynamic bond funds that will help you capture the capital gains. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.